Every dollar sitting idle in a savings account is slowly losing its battle against time. While the number on the screen might stay the same or inch upward slightly, the reality hidden beneath those digits tells a different story. That money is quietly shrinking in value month after month, year after year. For anyone serious about building wealth, understanding one fundamental truth becomes essential. Playing it safe with money often turns out to be the riskiest move of all. The world of personal finance operates on a principle that contradicts human instinct. People naturally seek safety and certainty, especially when it comes to their hard-earned money. The idea of risking what took months or years to accumulate feels uncomfortable, even frightening. Yet those who achieve significant financial growth understand something that separates them from the crowd. They recognize that without accepting calculated risk, true wealth remains forever out of reach. The hidden cost of playing it safe. Consider what happens to money that never leaves the comfort of a traditional savings account. A person deposits $10,000 and watches it earn minimal interest, perhaps 1% annually or even less. On the surface, this approach appears responsible and prudent. The money sits protected, insured, and readily accessible. But beneath this illusion of safety, a silent thief operates continuously. Inflation represents the steady rise in prices over time, and it functions like an invisible tax on purchasing power. When inflation runs at 3% annually while savings earn 1%, the real return becomes negative 2%. This means the money actually loses value each year, even though the account balance appears to grow. What could buy a certain basket of goods today will buy significantly less a decade from now. The mathematics paint a sobering picture. At an average inflation rate of 3%, prices double approximately every 24 years. That $10,000 kept in a low-interest account might grow to $12,000 over 2 decades. But the purchasing power of that $12,000 could be worth only $6,000 in today's terms. The saver technically gained money, but effectively lost half their wealth. This erosion happens gradually enough that most people never notice the damage accumulating. Bills rise, groceries cost more, and somehow the same income doesn't stretch as far as it once did. Many attribute these changes to lifestyle creep or poor budgeting, never recognizing that their conservative financial strategy has been working against them all along. The opportunity cost compounds the problem further. Every year that money sits earning minimal returns represents a missed chance to participate in genuine growth. While one person keeps $50,000 in a savings account earning 1%, another invests that same amount in a diversified portfolio. Over 30 years, the difference becomes staggering. The savings account might reach $70,000, while the invested portfolio could grow to over $400,000. Assuming average historical market returns. Understanding the risk-reward relationship, financial markets have demonstrated a consistent pattern throughout history. Higher potential returns require accepting higher levels of uncertainty. This relationship between risk and reward forms the foundation of all investing decisions. Those who refuse to accept any risk also refuse any meaningful opportunity for growth. Stocks historically deliver average annual returns around 10% over extended periods, though individual years vary dramatically. Some years bring spectacular gains, while others inflict painful losses. Bonds offer more stability, but typically return around 5 to 6% annually. Cash and savings accounts trail far behind, barely keeping pace with inflation when interest rates are favorable. The key insight lies in understanding that short-term volatility differs fundamentally from long-term risk. A stock portfolio might lose 20% of its value in a market downturn, causing panic and sleepless nights. But history shows that patient investors who hold through these storms almost always recover and ultimately prosper. Someone who invested in a broad market index fund and held for 20 years has never lost money, despite enduring multiple crashes and corrections along the way. This paradox confuses many people. They see daily price fluctuations and interpret them as danger, when in reality the greatest danger comes from avoiding the market entirely. A young professional with 30 years until retirement can afford to ride out several market cycles, benefiting from the compound growth that occurs when earnings generate additional earnings. The magic of compound growth transforms modest investments into substantial wealth over time. Imagine someone investing $500 monthly starting at age 25, earning an average 7% annual return. By age 65, that stream of contributions grows to over $1 million. Wait just 10 years to start, beginning at age 35, and the final total drops to roughly $450,000. Those 10 years cost more than $500,000 in lost growth. Different life stages demand different approaches to risk. A person in their 20s can maintain an aggressive portfolio heavy in stocks, accepting short-term volatility in exchange for maximum long-term growth potential. Someone approaching retirement needs to protect accumulated wealth, shifting gradually toward more stable investments. But even retirees require some growth-oriented assets to combat inflation over what could be 30 years or more of retirement. Strategic risk-taking for lasting wealth. Accepting risk doesn't mean gambling recklessly or putting everything on speculative investments. Smart risk-taking follows a deliberate strategy built on diversification, patience, and understanding personal circumstances. The goal involves taking calculated risks that align with individual goals, timelines, and tolerance for uncertainty. Diversification serves as the primary tool for managing investment risk. Rather than concentrating wealth in a single company or sector, spreading investments across many different assets reduces the impact of any single failure. A diversified portfolio might include domestic stocks, international stocks, bonds, real estate, and other asset classes. When one area struggles, others often compensate, smoothing the overall ride. This approach acknowledges that predicting the future remains impossible. Nobody knows which specific stocks will soar or crash, which countries will lead economic growth, or when the next recession will strike. Instead of trying to predict these unpredictable events, diversification accepts uncertainty and builds resilience against it. The timing of risk also matters tremendously. Young people possess a powerful advantage that older investors can never reclaim: time. With decades ahead to recover from setbacks, they can afford to take more aggressive positions. As retirement approaches, gradually reducing risk exposure protects accumulated wealth while still allowing for necessary growth. Understanding personal risk tolerance proves equally important. Some people handle market volatility without losing sleep, while others panic and make destructive decisions during downturns. Knowing which category fits best helps determine an appropriate strategy. Someone who sells everything during a market crash locks in losses and misses the recovery, often causing more harm than staying too conservative. The greatest risk many people face isn't market volatility or economic recession. It's the risk of reaching retirement age without sufficient resources to maintain their desired lifestyle. This risk grows larger every year that money sits idle, earning returns that fail to outpace inflation. By the time this danger becomes obvious, the opportunity to correct course has largely passed. Building wealth requires accepting that uncertainty and growth travel together as inseparable companions. Those who demand absolute safety sacrifice the very growth they seek. Those who understand this paradox and embrace calculated risk position themselves to achieve financial goals that cautious savers can only dream about. The path forward starts with a single decision, recognizing that avoiding all risk guarantees slow financial decline. From there, the journey involves education, planning, and the courage to act despite discomfort. Markets will rise and fall, economic conditions will shift, and moments of doubt will arise. But those who persist, who maintain their strategy through storms and sunny days alike, consistently emerge with wealth that passive savers never accumulate. The choice between risking nothing and risking wisely determines whether money gradually withers away or flourishes into lasting financial security.